those portfolios, historically at least, have done better over time relative to a pure indexing approach. Hey everyone, AFIP, James here. So wanted to do a quick follow-up video to a comment that we received on one of our shorts that went out not too long ago. It's up here on my screen if you can see it. We had done just a really short little snippet about kind of active investing versus evidence-based investing. And this comment came in here, Kaiser Blazer, just put your money in a passive index fund. And this one is really worth addressing. Because what Kaiser Blazer here is hitting on is actually, there's a lot of truth in this, right? Now, of course, everything kind of goes deeper beyond the surface, but that's why we wanted to take a quick look. So Kaiser Blazer is right? Passive index funds, that is modern portfolio theory. And if you compare that against active management, which was the video, yeah, I mean, it's very difficult for active management net of expenses to beat a passive, in this case, what Kaiser Blazer is saying, a passive indexing strategy. Okay. Now, what we want to highlight though is that you can go beyond passive indexing, right? Passive indexing is a wonderful, absolutely perfect starting point if that's where you're at. It's a great foundation, right? But there is a level beyond that, beyond just pure passive indexing, we would call evidence-based investing, right? And I just want to get into that real quick here and kind of address what Kaiser Blazer is hitting on and the truths behind it, and then just really show you the iteration or the evolution of where things are at now beyond pure passive indexing. So the fundamental thing with passive indexing is you are just holding all stocks in the US, internationally, emerging markets, really in their appropriate market cap. And all market cap means is like, take Apple here in the US, right? If Apple represents 2% of all of US stocks, then you hold 2% of Apple in your portfolio, right? And you just go through every stock. And as the size of that company changes in any given day, right, you are just holding the appropriate size of that company in your portfolio relative to the overall total, right? That is a market passive index approach in its purest form. Okay, right? And again, nothing wrong with that. If you can see on my screen here, this is another slide we've used before, but that would be represented by this green line, right? What you can do and layer on top of a pure passive indexing approach, though, is tilt the portfolio. And what that means is really change the weightings of the individual companies you're holding to incorporate some other factors that are well defined to produce a higher expected return over time. Okay, those three factors are small, so think small companies versus large companies. Number two, value, think value versus growth, and then number three, profitability, think high profitability versus low profitability. Right? If you can list every stock out there and define how large it is versus how small it is, and how growthy it is versus how value-y it is, and profitability versus low profitability. And if you change the weighting of those stocks to tilt towards smaller companies, more value-y companies, and higher profitability companies, then those portfolios, historically at least, have done better over time relative to a pure indexing approach, which is what the comment was based on. So hopefully Kaiser Blazer finds this helpful if he doesn't, or he or she doesn't already know about this. But the blue line here represents exactly what I'm speaking to, right? We call them factors, right? Value, small, and profitability. So the blue line represents a portfolio that is tilted, and just the underlying stocks are weighted a little bit differently than an indexing approach, to tilt towards these factors of higher expected return, right? And you can see that over time here, if you take those tilts in your portfolio, the portfolio has done quite a bit, not quite a bit, but quite a bit depending on how you define it, has done better than a pure indexing or market cap approach. There's a lot more that goes under the surface here. We're just trying to give a kind of a high level response. this also works across risk tolerances, right? So that first slide I was showing you was a very aggressive growth portfolio, but you can tick down how aggressive a portfolio is and hold very few stocks, say 30%, and the rest is bonds. Excuse me. As we move through these slides, right, I'm just illustrating that in a growth portfolio, so one level down from aggressive growth, the same result occurs, right? Blue, better than pure indexing, right? Conservative growth portfolio, just less stocks, more bonds, same trend, and then for the most conservative portfolio, also the same trend, right? Now, what differs here is on the left. If you see the scale, right? If this is if you invested $1, back in 1997, what that dollar would be worth today. What changes, obviously, is you're more conservative. This only goes up to worth $4. But as you go back up these portfolios, right, the scale is much larger, right? And again, you'll also notice the lines get a lot bumpier as you go more aggressive, right? As long as someone's willing to accept a bumpier ride, more up and down movement, then they're really increasing the scale of potential results down here. And that's what's showing in these graphs. So anyway, very much agree with Kaiser Blazer. Indexing is the antithesis of active management, and we would very much agree with that. And the point here is just that if you're already there in an indexing side of things, you will love the evidence-based approach because it's building on the foundation of indexing and just taking it a step further to squeeze even more expected return out of the portfolio than a pure market cap indexing approach would otherwise do. Anyway, till next time, have a wonderful day and catch you soon.